Hello, I'm James Desort, a CPA who's been working in the area of tax for 15 years now, with about 13 of those years being in the corporate tax environment, and my most recent 2 years being in public accounting. Today is August 18th, 2023, and at the time of this recording, I do currently find myself in the position of being in the job market. So just to help showcase certain aspects of my knowledge and skills, I've put together this brief presentation on indirect taxes. The area of tax has lots of nuance to it, so I'm hoping this will shed some additional light on the topic. Indirect taxes are those taxes that can be passed along to other parties, but not always necessarily passed along in a transparent way. And what I mean by that is, for example, when you make a purchase at a store, you will see an explicit line item for sales tax. However, for other indirect taxes, such as gross receipts taxes, you may not see a line item on your receipt. However, it is possible that the tax is implicitly built into the pricing of the product or service that you're buying. So here you see some examples of indirect taxes versus direct taxes. In the category of indirect tax, you see sales and use tax, gross receipts tax, excise tax, value-added tax in Europe, goods and services tax in Canada, and customs taxes. In the category of direct tax, you have income tax, net profits tax, and property tax. Now you'll see I have a question mark by property tax. This is because I don't necessarily agree that it cannot be passed along to the consumer. However, the industry consensus categorizes property tax as a direct tax, and I think this may relate to the fact that sometimes indirect taxes are thought of as transactional taxes. But you will pay property taxes every year on the value of the property, regardless of whether or not that property changes hands. But my argument is this: if someone renting an apartment complains to their landlord about the high cost of rent, what is the first thing the landlord will say? Well, have you seen how much property tax I have to pay every year? Additionally, any business creating a product that is going to know that they have to pay property tax regardless of profitability. So whether subconsciously or consciously, in my opinion, they're going to account for that in the price of whatever it is they're selling. But since consensus says property tax is a direct tax, I'll be leaving it there for now. Before moving too far ahead, I would just like to touch briefly on another term that is commonly misunderstood, and that term is state and local tax. Indirect tax certainly falls within the category of state and local tax, but income tax can also fall within state and local tax. I've had this conversation many times with recruiters. They'll call me up and say something like, "Hey, I see you have many years of experience in state and local tax, and I think you're a great fit for this job opportunity. So can I ask you, how much experience do you have preparing partnership returns?" And then I have to explain that partnership returns are a type of state and local income tax, not state and local indirect tax. And my specialty is indirect tax. So that's just something to keep in mind when thinking about all the nuances of the tax profession. Indirect taxes and income taxes can both fall within the realm of state and local tax, but indirect tax is a classification unto itself. Now let's discuss a little bit more about sales and use tax. Sales tax is collected from the customer and remitted to the government by the seller. Of course, not all sales are taxable. You can have non-taxable sales as well as exempt sales. For example, groceries are typically not non-taxable altogether, but an exemption could apply to other sales that would otherwise be taxable. For example, nonprofit businesses or businesses purchasing inventory materials or ingredients to be sold again later can present an exemption certificate or reseller permit, and sales tax would then not be assessed or collected on that purchase. Vendor's use tax is essentially just another fancy name for sales tax. It's a way that some states differentiate between sales tax coming from businesses with a physical presence or storefront in the state and businesses located out of the state but remotely selling to consumers who live in the state. So the vendor is still collecting and remitting the tax, even though it's being referred to as use tax. True use tax, on the other hand, is not collected by the seller at the point of sale, but is still due to be paid by the consumer. Just because the seller doesn't collect sales tax from you doesn't mean you're not on the hook to pay the tax. And when the consumer pays the sales tax directly to the government, this is referred to as you paying your use tax. For example, when an individual passes through Oregon and stops to purchase a television to be used in your home state, you will not be charged sales tax. However, technically, the law does still require you to remit use tax to your state of residence for that purchase. Not many people comply with this rule, but technically, you are still liable for that use tax. Now, businesses are dealing in higher aggregated amounts, and a sales tax audit will conveniently also include a use tax audit in connection. So businesses need to ensure they are paying their use tax as appropriate. Otherwise, a significant assessment could result from an unanticipated audit. Now we'll discuss some gross receipts taxes. Gross receipts tax is a tax levied on the total gross revenues of a company with no deductions for cost of goods sold or expenses. Some common examples of gross receipts taxes are the Washington Business and Occupation Tax, Ohio Commercial Activity Tax, and the Oregon Corporate Activity Tax. Now, I put a question mark on the Oregon CAT because this one can be particularly confusing with regards to how it's classified. Those tax professionals who are already familiar with the Ohio CAT might be inclined to simply classify the two into the same bucket. However, the Oregon CAT is commonly classified as an income tax because of the fact that it does allow for a 35% deduction of certain cost inputs or labor costs. So please just be aware of that little nuance with regards to the Oregon CAT. And moving on to VAT. The value added tax can, in a general sense, be thought of as a European sales tax, although there are other countries that levy a value added tax as well. Some businesses assign VAT compliance to the international tax team, but others assign it to the indirect tax team. VAT is levied on the gross margin or value added at each point in the process of manufacturing, distributing, and selling an item. So when a business goes to file their VAT return, they're reporting the amount they paid to their suppliers and the amount collected from their buyers. If the amount paid to suppliers is greater than the amount collected from their buyers, the business will request a refund of the difference on the return. However, if the amount collected from buyers is greater, then the business would remit that difference with the return. And with that, it brings us to the end of my presentation. I hope you've learned something by watching, and I hope this presentation will give you the confidence you need to engage in more indirect tax projects as you advance in your career. Thank you.